our next presenter, we have two, Tyler Wood and Alex Cole. Tyler and Alex do a really, really good job. If you have Metastock 18, as part of Metastock 18, they actually gave you a free trend analysis that they're going to cover. They have quite a bit more that's also included, but they also do a really good job. They're going to come in and talk next. So Tyler, how you doing?
Hey Jeff, long time no see.
Hey Tyler, it's good to see you. Yeah, it's been at least like a month. Oh, you dressed up. You're looking great.
Every once in a while, it's important to put on a tie and remember that in the morning you come around. Get my mind focused. Yeah, but it's good to see you.
Alex, I know you like to go by Alex, and we always call you Alex. Is it Alexander? Is that your official name?
Only when I was in trouble with my mother growing up.
Yeah, that's the only time I hear Jeffrey.
Yeah.
All right.
In fact, funny story real quick. When I was young in school, they made us write our full name, and I would write Alex and my middle name Ander and my last name Cole, because I thought that was just my middle name. I'd never been called Alexander in one go.
Ander, that's a great middle name. I'm going to start nicknaming you that, bud.
Yeah.
I think that's great. I think that's also cool because my daughter's name is Annabelle, but her middle name is Bell. And then my other daughter's name is Ash Lee, but her middle name is Lee. So
she's not Annabelle Bell then?
No, just Annabelle. Her first name's Anna. Her middle name's Bell.
I like that. That's
From the
good.
Department of Redundancy Department.
You're right.
Annabelle Bell. Oh, Jeff, thank you so much for having us here today. What an awesome day so far. You have had a killer lineup of presenters and educators, and hopefully the audience is ready for a little more, maybe refreshed their cup of coffee, ready to dive into a little more education.
All right. Well, I turned off my camera, so that means I'm getting out of your way. You guys go.
Fantastic. You can see my charts okay? Everything's coming through? Awesome. So everyone, thanks so much for sticking with us. I know we are in the middle of the trading day, but hopefully you can take a second, step back from your screens just to think a little bit about the process and tools that you use every day in the markets. Alex and I are so appreciative to Jeff and Kelly and the entire Metastock team for giving us an opportunity to come here and teach. Alex and I have known each other for well over a decade, and mostly in the context of teaching institutional investors about technical analysis. A lot of them, like myself, going through an MBA program, you get a strict diet of bottom-up financial statement analysis and sort of the fundamental view of the companies that we're talking about investing in from an equity perspective. But today we're going to talk a little bit about GoNoGo Charts, whether or not these tools become a part of your workflow. Hopefully today's session has a lot of value for investors of all stripes. And hopefully we're talking about some big picture concepts that you can take and put to work in your own trading. So our company is very, very new, but these concepts and tools are really timeless. So let's dive right in. For anybody who's been attending webinars that we've been hosting with Metastock, hopefully these first few slides will just be a little bit of review, and we'll get into some current markets. But as we dive into the concept, I think we have to ask ourselves just a little bit about how trading has felt, maybe this year versus last year, or maybe last year versus 2021. And if you can recognize, or maybe you've been keeping a trading journal, recognize that your emotions might look very different from year to year. And even the trade length or trade size might look different in a bull market versus a bear market. What we're focused on as investors is developing a repeatable process, a system. A lot of people they spill a lot of ink in financial news media and give a lot of airtime to talking about algos. Well, algos is just a system of rules, a setup where you can automate your trading. And certainly understanding how to code in Python is very, very helpful. But it starts with having an idea about what your checklist might be, a rules-based approach, something that you can do repeatedly to help remove some of that emotional bias, some of those, I guess, underpinnings from our behavioral heuristics. And so for Alex and I, the concept behind GoNoGo Charts was exactly the same as what most fund managers and institutional research analysts are producing, which is a systematic approach to the markets. But instead of leaving our algo in a black box, and telling everybody to just trust us that it works, we thought we would put it back on the chart, use data visualization to our advantage, and so that everybody can see how the tool is working in real time and use it in your own way. I think one of the difficulties with trading is there's a lot of sort of paint by number or mimic somebody else's trading style, which may work for a time, but trading is deeply personal. And so you need to be able to customize things to your own objectives, your time frame, and all the rest. So just to help illustrate this point, I'm going to speak for you, Alex. You're trying to teach a 16-year-old how to drive. So I'm sure right now you're going through a little bit of a traumatic moment trying to keep this kid safe and other drivers on the road. But as you learn to drive or learn to fly an aircraft or sail a boat, you name it, you're going to start, before you ever get behind the wheel of any vehicle, you're going to have this rules-based checklist, this approach that you go through every single time. It's the exact same sort of operator's manual, if you will, to keep yourself safe, to make sure that you don't make ridiculous mistakes and injure somebody. So if we apply that to technical analysis, we might have a similar checklist, multi-step approach, where we're looking across the markets and across a varied mix of indicators to give us a weight of the evidence. Is it safe to merge into the traffic light? Is there a trend that we can join? Can we on-ramp to this security? And we might use a mix of things, trend lines and some of the classical stuff. We might use a mix of indicators. We might look for confirmation between those indicators and what's happening with the price action. But Professor Cole, why don't you walk us through very specifically what this might look like in a rudimentary or a very straightforward technical approach to identifying trends?
Yeah, and I think we can all agree that we've spent some time in technical analysis that trend identification is that all-important skill, because if we can identify a trend, then we can trade in the direction of that move, right? And we can profit from the bulk of that movement in price. It sounds really easy, sounds really straightforward, but it certainly isn't. So what we need to do is be objective in trying to do just that. So what might we do first? Well, we might eyeball the chart. And of course, here we can see that it's going from bottom left to top right. Nothing tricky there, right? It's a series of higher highs, a series of higher lows. We know that price has moved in a trend, but it's easy to do this after the fact. But how do we identify when the trend is beginning? Because that's, of course, what we need to do to be able to profit on that movement in price. So we're going to probably turn to something that allows us to automate the process and remove that subjectivity. So we might go to something like the Donchian channels. That's going to automatically find higher highs and higher lows for us, because what the Donchian channels do are look back at a period in price action and just ask whether or not price is the highest price has been. And if it is, then you'll see that green line move up. The green line above price, of course, and the red line below price moving up as the lows move up. So it just allows you to visually, somewhere sort of in, I guess it's end of March, April there, we're getting a new high there in the Donchian channel. And if you have any interest in the history of trading, of course, I'm sure everybody does, but don't be shy about looking up the Turtle Trader experiment and those amazing story, and those traders use Donchian channels as one of their primary entries in that whole experiment. But then what might you do after that? Well, you might then turn to something like a simple moving average. If anybody's looked at a technical chart or even a financial chart, they've probably seen a moving average on it. Moving averages aren't really even considered, I mean, maybe that's a stretch too far. They're, of course, technical analysis, one of the earliest tools that we've had. But in some platforms or some charting packages, not really looked at as core technical analysis because they're so prevalent. So everybody has a moving average on their chart. It's inherently bullish, of course, if price is above its moving average, because what that tells us is that price right now is trading above the average of its prices over whichever period you're looking at for the move ad infinitum on charts. But certainly adding another one can provide value, because that allows us to look for crossovers. And now we get the idea that a short-term average moving over a longer-term average, that gives us a sense of direction, because we're able to smooth prices but still get the information that shorter-term price activity is moving in this direction we're looking for faster than the average of its longer period. So looking at a moving average cross is very important. But we might go on from here and look at something else. Of course, if you've had any background in technical analysis, you'll have probably studied Bollinger Bands. John Bollinger, an absolute innovator in our space, done so much great work, and we're privileged to have been able to hear from him and meet him at events and learn from his work in the industry. And the Bollinger Bands are just a brilliant concept because they plot bands around price that encompass the vast majority of the data. So if we think back to our math classes when we were younger, we know that around a mean, 2 standard deviations should encompass about 95% of the data. Now that's of course for a normally distributed data set. Financial data is not normally distributed, but the vast majority of price action should fall within those bands. So when it doesn't, that's significant, that's important, that's something unusual happening on the price chart. So we know from reading about Bollinger Bands is that when price trades up and out of a band, we can trade in the direction of that break, especially if those bands are narrow, right? There's certain interpretations of the Bollinger Bands, but right there in that same sort of area, we've now got Bollinger Bands being broken to the upside, as well as price being above its moving average. We had a moving average cross a little bit later there. We've got Donchian channel new highs, right? We're starting to stack the weight of the evidence in our favor. But we can go on, right? A lot of people will add something like volume to the chart. This is the first of the non-price indicators that probably you'll have on a chart, and it's been used as a confirmatory indicator to provide understanding of how much market participation is affecting what we're seeing in price, how much enthusiasm is there in the price movements that we're seeing on the chart. And that goes all the way back to Charles Dow, when he was talking about how volume could be used to confirm price action. So you want to look for volume. Is it healthy when we're seeing a breakout in price? Is there thin volume when price is doing something? Does that change the way you think about what's happening on the price chart? And then we can keep going. Let's add one more on here, Tyler. We might look at an indicator on the lower panel. So we might look at something like the MACD, which blends a little bit of trend following with a little bit of momentum concepts, in that it looks at the difference now between 2 moving averages, the exponential moving averages in this case, but it looks at the difference between them. So we get something that oscillates around 0. So we're looking at the difference between 2 moving averages. And again, bullish inherently bullish in understanding that the MACD, if it's above 0, means that prices in the short term, again, are moving higher than prices in the long term. So we might be looking now at MACD and saying, okay, where's MACD crossing its signal? Where does MACD become greater than 0 for the first time? Where do I get a new Donchian channel high? What's my moving average situation? Am I seeing any crosses, Bollinger Bands tightening, and then a breakout to the upside? What's volume looking at? And so somewhere in that circle there, we're getting all of those criteria being met. And so we're going to be fairly confident now at some point in here that we can recommend a long position. We're starting to identify a trend in the up direction. But we've reintroduced some subjectivity, obviously, because we have to make the decision where in that circle, how many of those criteria need to be hit for me to feel confident to make any kind of movement based on this price chart.
It's the entire first quarter of last year. And, spoiler alert, Alex and I were cherry picking for a security that has a very clearly defined trend, right? Apple is sort of the poster child in terms of a trend follower's delight. So even on perhaps the simplest security to trade, right? And even with a very responsible but simplified process, we're looking at 6 or 7 things. We still have 3 months of trading activity whereby all of our process is stacked up. Now imagine the kinds of charts that Tyler Jr. used to create before at GoNoGo, or perhaps all of you. You may have a more sophisticated approach. And this is not to denigrate any of the incredible studies that are out there, the men and women of Wall Street, many of them of the CMT Association who helped to create, innovate, and discover all of these tools. I mean, we're lucky to be alive at a time when we've got so much data and so many really powerful ways to look at it. But when you get a chart like this, there are 2 problems. One, you have indicator overload, as Alex was just saying. How do you make a decision in that first quarter of last year to get involved in the new trend that's emerging in Apple? Whether you're looking first for that Donchian channel break or waiting for that moving average crossover, it's somewhere in there. Now, imagine a choppier security or needing to make a decision even more quickly to take advantage of trends. Now you've got this indicator overload, and this analysis paralysis that takes over starts to reintroduce a lot of that emotional subjectivity. If you're like me, with enough squiggly lines on the chart, you can sort of convince yourself of holding on to a losing position or waiting to enter a trend. If you're particularly negative on the markets, even if all the weight is stacking up right in front of your eyes. We as human beings tend to drift towards confirmation bias. And so if we have an emotional opinion, we're going to collect the data that supports how we already feel about the marketplace. So we want to remove all that subjectivity, but we want to still retain all of the information from those powerful indicators. So when I was talking about the algos before, Alex and I have a trend model. And many fund managers out there do. What we're doing is taking that weight of the evidence, a lot more indicators than what we just went through in that simple process, but taking all of that and blending it in the background so that we have a weight of the evidence approach. And then taking the result of that trend analysis and painting it back onto the chart. So for those of you who are new to GoNoGo Charts, just a quick review. We've got Go Trends, right? The name of the company is Go or No Go, like a pass-fail system. If you were NASA thinking about launching billions of dollars of hardware into space, you want the conditions to be optimal before you take that decision. So Go Trends, strong form of the trend model in blue bars, weaker form of a Go Trend condition in these aqua bars. And then to the downside, we have no-go trends. So pink is the weak form, purple is the strong form. And here at these areas of transition, sometimes what the model is telling us is that the market has reached an area of neutral readings. All of those blended indicators in the background are giving us a go fish signal, meaning that the market is uncertain. There isn't enough evidence to one side or the other to indicate trend and the strength of that trend. We're big fans of the life and work of Jesse Livermore, who said that in all markets, there's a time to go long, a time to go short, and a time to just go fishing. Sometimes the signal of the market is that it's just moving sideways, it's range-bound, choppy, or uncertain. So that is the very simple way that we think about using technical analysis to our advantage, but maintaining our focus on the most important indicator of all, which is price action. Alex, talk us through this next quote.
Yeah, one of our absolute favorites, and it's from Mark Abraham. What he says is, ultimately, it is the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down, and that consensus is revealed by analyzing price. So that's us as technical analysts, right? We look at price charts. We believe that everything that is fundamental about this company is reflected in the price, as well as the collective opinion of all market participants. That's the piece that fundamental analysis doesn't get, right? We can understand the fundamentals, but it's also the collective opinion that at the end of the day settles on a closing price, and then of course settles on whether or not that price may go up. So the consensus of collective opinion of all of the market participants is revealed by analyzing price. So that's why we want to be able to keep our attention focused on the price panel.
And I'll be back at 5 o'clock this evening to talk to everybody more in depth about, thinking about the quality of the company, what's on its balance sheet, how's the management team doing, thinking about the valuation of the company. And there's lots of different ratios and estimates that we could use to come up with an idea of intrinsic value for a corporation. And then, of course, there's the growth factor. Our returns on equity expanding? How about gross margins? And we can look at a lot of fundamental data sets. But as Mark Abraham tells us, perhaps we don't have access to all of that knowledge. If we're trading global equities, I don't know the first thing about semiconductor manufacturers. It's, for sure, I don't know about Taiwanese semiconductor manufacturers, but can I be a responsible investor and still participate in those trends? Absolutely, because all of that information is distilled into price. And we'll talk a little bit more about that this evening. But what's exciting about all of this work for Alex and I is just to get it out to the world. So we give the GoNoGo Trend Indicator away for free to all Metastock users. It's right there in your platform. You can apply that template right after this talk, or maybe even have a couple of screens. You can try it out right now. And so that's available in Metastock for everyone to use for free. All we would ask in return is let us know how it's working for you. What sort of time frames are you trading? What securities are you trading? Has it changed the way you handle your trading discipline? And we're going to talk about that a little more in the second section of today's talk. But Alex, let's go through a couple more charts of Apple specifically using the GoNoGo trend based off of last week's closing prices.
Yeah, and this is the weekly chart. We work with people that are using all different periodicities. You might be trading 10-minute charts. We might be talking to a fund manager rebalancing quarterly. So it's important to understand, and we'll talk more about multi-time frame analysis. But just to give you an example of how we would look at a chart like this is the weekly chart of Apple. And we can see as the price has rolled through its trends, what the GoNoGo trend indicator shows us. And that is that there are periods of weakness. If you look at the most recent period here, we can see that it came off the high and that we saw some weakness with the paler aqua bars. And then the trend resumed, stayed in the Go colors, and now we're back painting strong blue Go bars. You can also see that really sloppy, choppy 2022, most of 2022, was then highlighted by no Go and amber bars. So we were told by a GoNoGo chart here that the Go trend was over. We're now painting uncertain bars of uncertainty. We're painting no-go bars. We're painting pink and purple. So we're staying away from that if we're long investors until we see the trend clearly resume. And that, of course, happens just about the end of Q1 2023. And now we've been in a Go trend since. And we're looking to, possibly run up against all-time highs.
Absolutely. We work with a lot of institutional investors, registered investment advisors, and for them, these seductive relief rallies, right? They're fairly short-lived, but I use the word seductive because who wasn't hoping to resume 2021's bull market activity in the middle period of 2022, right? And this was, for a lot of investors, a time when they felt confident enough to get back into the trend. On this weekly time frame, we never re-entered the Go trend criteria. The model did not suggest there was enough evidence for Apple to take off to the upside. Of course, we're going to move past just weekly charts, but the idea of long-term investors, in whatever time frame you're is, to stay out of no-go areas and to simply take positions when the trend is in your favor. Now, Alex, we've been talking about weekly charts here. I'm sure for a lot of folks on the line, they're thinking, wow, this might not be for me. I'm a shorter term trader. Well, thanks to the original, the OG technical analyst here in the West, Charles H. Dow, over 130 years ago, this gentleman, without any computers, without any algos, understood market movements. And he used this analogy to the oceans. He was an accomplished nautical sailor. And he said that the primary trend, this longer period of any stock or the market index at large, is like the tides of the ocean. It is not changing based on the whims of investors or the news of the day. This is about expanding GDP. This is about the underlying fundamentals of the company continuing to expand. They have new products. They're a good company. That's what's going to drive our primary trend. And we can look at that over years and decades. But he also identified that just like the oceans, there's a secondary period. He compared this to the waves of the ocean, and that in our secondary trend, secondary time period, we could see prices move well below or well above that primary trend, the underlying drift of markets or a security. And then, of course, he identified the minor period or that tertiary trend being the ripples on the surface of the water. So if you're a short-term trader, if you're looking at intraday charts, they could be very, very short-term, you can absolutely make money on those short periods. However, it's helpful to understand what the primary and secondary trends are telling you about that security. And we're not locking those periods into any one kind of periodicity on the chart. But for you, if your trading period is on a minute, 60-second chart, maybe looking out to an hourly and maybe a daily chart as your longer term period would let you know if you are trading against or with a longer term trend. So let's go through Apple on a couple other time frames just so we can understand how this might look. And Alex, I think what jumps off the screen on that weekly chart again of Apple is that anecdotally, when we see major breaks of trend lines, areas of support and resistance, that's often concurrent with changes in trend. And that classical technical analysis, being able to highlight areas of key support and resistance or trend line breaks, just adds to our conviction. And it's very simple to do on a chart that isn't cluttered with a ton of indicators. So let's move down from that weekly basis. Talk to us about what's happening on the daily chart of Apple.
Yeah, so this is the daily chart from this morning, and you can see that we have really nicely emerged from that no-go trend just over a month ago now, and we've put in a new higher low. That's really nice to see, right? We saw that go trend take shape back in the beginning of November. We moved higher, and then we sort of saw a correction. We highlighted that weakness with some of those aqua bars there, but then we've returned to paint strong blue go bars again, and we're moved higher. So we now have a higher low and a higher high on the daily chart. So we're second higher high, actually, a second higher high and a higher low. So we're looking at now a new trend well and truly in place on the daily chart, and we'll look to see if we can get back and test those highs from a year or so ago. And then this is the 60-minute chart dropping down in time frame. I mean, think about how you might use technical analysis depending on what you're doing in the industry, whether you're in the professional space or not. But you might be a trader working for a PM. The PM may say, listen, weekly chart is a go, daily chart is a go. I want you to take a position in Apple for me, please. You might drop down into smaller time frames to look for sensible entry points, right? So if you're looking for a go trend on the 60-minute chart, because you know that your larger time frames are also both go trends, then you'd only be taking go trend opportunities on the smaller time frame chart. Now, of course, you might not be that long-term of an investor. You might be using, the daily chart as your large time frame, or even the 60-minute as your large time frame, and then dropping down to 15-minute charts and 5-minute charts. So the point remains is that technical analysis, being fractal, should work the same on any time frame. A good suite of tools or a good checklist should be able to be applied to any time frame and any asset class.
Absolutely. Speaking of other asset classes, I'm sure many of you don't strictly trade equities. You might be Forex traders. You might work in the futures markets and look at a lot of commodities. Regardless of whether or not you trade across asset classes, I encourage everyone to at least pull up the charts, because there is a ton of information when we're looking at interest rates or fluctuations in dollar strength or even the commodities markets. And it's the great John Murphy, a fellow CMT charter holder, who first sort of showed the world this idea of intermarket analysis. In the CMT program, you're going to learn a lot more from folks like Marcos Katsanos, who've helped to quantify what some of those correlations tell us about the influence between asset classes. But just for sake of argument, right? As technical analysts, we want a top-down perspective. Technical analysis gives us a lot of information, contextual information about the environment in which we're going to be trading. And so if we do a little bit of research ahead of our week's trading plan, that can set us up for understanding a little bit more about the macro environment and what potentially could be an influence, headwinds or tailwinds to the securities that we're trading. So this is just a simple 6-chart, multi-chart layout of securities, all just using the Go trend. Alex, why don't you take us around the round robin, and let's talk through what's happening in markets.
For sure. So we're looking at the top left here. This is the S&P using the ETF, of course, the SPY. We use ETFs a lot because we can get volume information. We'll talk about that later on. But the trend is a strong go, as we mentioned, on the S&P. We're seeing a return to those bright blue bars. So that's a good thing for the bulls out there. Strong go trend on the S&P. If we move across, Treasury bond prices, that is also in a go trend, but we're seeing the first weaker bar there. So a little bit of weakness after that new high in Treasury bond prices. Of course, bond prices move inverse to yields, of course, so just be aware of that. Crude oil on the top right, strong no-go trend. Oil was a bit choppy a couple of months ago, and it's really found its direction. Now we've seen a no-go trend, set a series of lower highs and lower lows, so strong no-go bars for U.S. oil. If we move to the bottom left, that's Bitcoin, of course, and what a week it had last week. A strong bar today, though, which shows that we're now in a weak go on Bitcoin. But look at that move in Bitcoin, really being quite impressive over the last few months. We can see that trend clearly on the chart there on the bottom left. In the middle on the bottom, we've got gold. Gold, of course, people will talk about it all day long and talk about how it should be a flight to safety. Sometimes it is, sometimes it isn't. At the moment, we are in a go trend. The weight of the evidence tells us we are in a go trend, but we are painting weaker aqua go bars. So we're seeing, you can see there, though, higher high, higher low, and then we'll see if we find support somewhere around here and put in another higher low. But a go trend still in place for gold. If anybody's interested, have a look at those super long-term charts of gold, right? Some really interesting things happening on 20-year charts of gold. We could talk about that another time. On the bottom right, we've got the dollar, or the ETF that represents the dollar, the UUP. The dollar, of course, had a really nice strong move for 3 months or so, and then rolled over into a no-go trend. It's rallied over the last couple of weeks. We see that weakness in the downtrend portrayed by the pink bars. It's come out of those purple bars, painting pink bars now as it comes up against resistance from what used to be support at the end of that go trend. So you can see there, important moment for the dollar as it we'll see whether or not it maintains that no-go trend or not.
Absolutely. This all-important concept of polarity in technical analysis, what has been support can become resistance or vice versa. And so being able to do a little bit of classical technical analysis on your chart, at least for Alex and I, has been really important. And this chart of gold right there at what could be a support level. And if not, if broken through, that's a serious signal to us to the downside. Now, we talked about data visualization just briefly, right? Blending lots of tools to give ourselves more information with less clutter. And just to illustrate that point, one of the things we do for our institutional clients is an array of different heat maps. These are the absolute trends of those same 6 markets that we just looked at, but we're removing the price action. Just so you can start to see sort of that rollover when we were in 2022's bear market in US equities, transitioning from pink and purple trend conditions through neutral back into the go trend in 2023. Bond prices have continued to move lower in no-go trend territory. And then, of course, we can move down that list. But it's just another way to visualize even more information at a glance, and certainly helpful if you are doing some top-down analysis. If that all sounds interesting to you, but trading, it takes up enough of your time. If you're interested, we do offer subscription research from GoNoGo Charts. That's actually where this company started, was sharing with some fundamental managers how they might look at trends and to help their positioning and technical asset allocation. So twice a week, every Monday morning, narrative format, top-down approach across the asset classes into the sector groups and down to the individual security level. And then every Saturday morning, we like to practice what we preach. Launch Conditions goes out, and it's a chart pack, which is probably a historical reference that some of the youngsters won't recognize. Back in the day, you used to actually get packs of charts all printed out for you and do a little weekend review. Longer time frames, global indices, cross asset, just to get a sense of the context in which we're going to be trading. So you can check out more of that at GoNoGoCharts.com if you're interested. But Alex, let's shift gears here. We're past the 50-yard line. Let's talk a little bit about the second half of today and what we're trying to do as traders.
Yeah. So we know this. If we're going to be honest with ourselves, we know we shouldn't be anticipating any kind of movement in price. We know we shouldn't be trying to say we know what's going to happen. We certainly shouldn't be doing that. What we want to do is participate in trends that we have identified. And that's the whole first part of this presentation, was how to do that sort of trend identification. But again, we want to do it in a way that removes any kind of confusion. We don't want the uncertainty that comes with trying to read panel after panel after panel and indicator after indicator. And if we can do that by using a disciplined checklist, but in a way that's easy to understand, we can stay objective, we can stick to that rules, and then we can hopefully act responsibly and without any of the emotional problems that we know are pitfalls for so many investors.
So get excited. This is the audience participation section of today's presentation. Feel free to shout these answers out at home. You can type them into the chat. We'd love to hear from all of you. But to help illustrate this point, right? So we've got our analysis. We're studying our charts. We're identifying trends. How about the trade management, the life cycle of the trade? And let's talk a little bit about how challenging this really is. It's very simple to say, it's very difficult to execute in real time. And to help us with this point, we're leaning on some research written by Professor Terence Odian. He's a Berkeley Haas School of Business professor. He and his fellow researchers looked at 360,000 trading accounts over a 15-year period. It's a lot of data to crunch through. I think in the research world, they call that statistically significant data sets. And the question in front of us is simply, what percentage of those traders do you think lost money over a 15-year period? Right? This research was published in 2011. We saw multiple market cycles changing from bullish to bearish and back to bullish. And the question is, what percentage lost money? Do you think it was about a third? A. B, 54%, C, 68%, D, over 75%, or E, 87% of those 360,000 day traders. I'll give you just a second. You can throw it in the chat or the question section, shout it out at home, scare your dog, whatever you need. Here's the answer. E, 87% of these traders were unable to be consistently profitable over 15 years. That means that only 1 in every 360 people, or less than a third of 1%, were consistently profitable. Now there's a follow-up question. And here we're leaning on the same research team led by Terence Odian. And instead of thinking about their overall accounts over 15 years, they went from the macro to the micro. Now they looked at 43 million individual trades from an FX broker. They grabbed some 15 different currency pairs, and they looked at the individual trades to try to discover whether there was some directional validity or errors. And now my question is, what percentage of these trades were profitable? A, 13%, B, 18%, C, 27%, or D, 39%, or finally E, over 50% of the trades were profitable. Now, we just said 360,000 people failed to make money consistently year after year over those 15 years. So take a second, throw it in the chat. And the answer is E, surprisingly, over 50% of those trades were directionally correct, right? So this is what that data looks like. The average retail trader has a win-loss ratio greater than 50%. So why on earth would so many lose money? Right? We spend most of our time trying to get our trades right. And in fact, most of us can even be successful in picking a directional bet with our trades. The answer for the money loss comes from the profit ratio. So they are holding on to losers far longer than they are holding on to winners. Their average loss per trade far outweighs the average profitable trade. So that edge is there on the analytics side, but the discipline for money management is missing. Okay, like we said, simple to articulate, very difficult to execute. Now to help us illustrate that point, right? Our expectancy formula, this is the efficient frontier. This is where any trading system is going to break even. It's just the combination of the percentage of winning trades multiplied by the profit ratio, okay? We could talk all afternoon about topics in behavioral economics, about the heuristics that all human beings are subjected to. We could talk about the works of Amos Tversky and Daniel Kahneman, the 2002 Nobel Prize winner in economics. Really brilliant, not an economist, but a brilliant behavioral psychologist. And they helped us identify this prospect theory. The fact that we experience a whole lot more suffering from a loss than we experience joy from the gain. And when we translate that to our trading accounts, we're going to quickly lock in a 10%, 15% move. Great, celebrate that win, but we're not going to hold it through the full length of the trend. We want to make sure that we lock in our profits. And when something starts to trade against us, right? Well, now it's not a trade. Now it's an investment. I have such conviction this turnaround story is coming back. I'm definitely going to get back to break even. And you might sit there holding this as it moves 10% against you, 20% against you, 50% against you. We've had multiple once-in-a-lifetime market disruptions in the last 20 years. So the risk is there. That part is certain. But let's just pick on one dot on this chart for a second. This is a 50-50 scenario. So imagine your whole analytical discipline. You don't even look at charts. You just flip a coin. Buy the security or don't buy the security. you can still have a profitable trading system with absolutely no knowledge of what you are purchasing, so long as you let those winners run and you cut those losers short, right? That's a 2-to-1 profit ratio from that trading system. And some of the greatest trend followers in the world, and I'm talking about David Harding from Winton Capital, or Jerry Parker, one of the original turtle traders who runs Chesapeake, they're really comfortable over here, meaning 30 to 35% of their trades are exceptional winners, and they're fine. They're comfortable being wrong a lot of the time. They're widely diversified. They take a lot of small bets, but they have really great trading discipline, really great money management. So the next part of today's talk is about how you can use GoNoGo Charts, the complete set of tools to help you with that money management side, right? The analytics are super important. We want to participate in trends. But if you can also add volume, volatility, and momentum to your understanding, you can help manage those positions. So Alex, I'm going to turn it back to you. And why don't you talk a little bit about the complete chart and what that looks like in Metastock?
Yeah, because when we are talking to anybody in the industry, we need to give a complete understanding of technical analysis for whatever it is they might be looking at. And that, as you rightly said, includes momentum, volume, volatility. So we know about GoNoGo trend. We've talked about that. We're going to talk a little bit about the GoNoGo oscillator, which gives a complete understanding of momentum, but does it all in one panel with the same approach of blending some of these robust momentum concepts together. We're going to also talk about some data visualization cues we have that help us understand what we're looking at. Those are the GoNoGo icons. And then, of course, we're going to also talk about volatility and how we look for reduced periods of volatility that can lead to significant moves with the GoNoGo squeeze.
All right, so let's talk a little bit about leading indicators versus lagging indicators.
Yeah, so this is when we would go into momentum, right? After we've established trend, anybody looking at charts or a technician will want to get a sense of how volatile or how strong the price movement is. And that's what these oscillators will give you. They'll give you a sense of price velocity, how fast something is moving in any one direction, right? And we can look at extreme areas of overbought and oversold. We can look at when a price has moved maybe too far in one direction and come back. We can also understand how we can take a look at using oscillators when in trend. That's been a big area of research over the last several decades.
Absolutely. So instead of diving deep into all of the different momentum oscillators that we could be using, let's take for granted the idea that we're blending multiple indicators into a single price panel. The GoNoGo oscillator is going to be a range bound. So unlike rate of change and some of the other oscillator tools that you might use that are unbounded, we're just moving from -6 to +6. And we can use that in the exact traditional way that we would use other momentum oscillators, looking for areas of overbought and oversold readings. So extremes in price move that might lead to exhaustion points in a trend. But what's really powerful about the GoNoGo oscillator is the idea of an objective zero line. So positive momentum, negative momentum, and we're going to talk in just a second about how we use that in the context of trend. What we've done with the implementation in Metastock is to also incorporate volume, where you've got this ribbon at the bottom. We know that heavy relative volume is really important when we're starting to digest whether the market is participating in a move. And we can see that just where this dark shaded blue area shows up on the ribbon. That's where we have heavy relative volume against the look back period. Now, Alex mentioned areas of divergence or confirmation, right? We can see at the end of this trend, price continues to make higher highs, but our GoNoGo oscillator is making lower highs. And the way that I was taught about momentum is that you throw a baseball in the air, it's going to be moving fastest when it leaves your glove. It's going to reach the apex, as high as you can throw it, and it's going to continue to climb as it gets to that high point, but it's going to be moving higher more slowly, not as fast as when you first threw it. So when we're looking at any momentum oscillator, we're looking at those areas of exhaustion. That's the concept of divergence. So a bearish divergence here, as price makes these ultimate highs, the oscillator is making lower highs. Alex, anything else that we want to add here on the GoNoGo oscillator?
No, I think just the most important point is coming on the next slide. So
fantastic. Why don't you take this one?
Yeah, so what we know about the oscillators that we've looked at is that they range from let's say a bounded oscillator might go from 0 to 100. If you think about something like the RSI, right? We know that an overbought RSI level is over 70. That's what we've been told. We know that an oversold is under 30. But what happens when a security is trending strongly? It's not going to swing from overbought to oversold. What we tend to find happening is that it rallies up into overbought territory, and then it comes back into neutral, so that we wouldn't expect an RSI to be oversold if a trend in price is very, very strong. What we find is that those oscillators range between neutral and overbought, but they're very choppy. Sometimes we don't know where to set those ranges. Sometimes we have a hard time with being sort of honest enough with ourselves. Like if we get down to a level that should be support, but it breaks a little bit, is that okay? Because we don't have those clearly defined ability levels that we can use for trading ranges. What we did when we designed the GoNoGo oscillator was calculated in a way that when all of the blended inputs are in their respective neutral territories, the GoNoGo oscillator will fall to the 0 line or rise to the 0 line if it was negative. So what happens then is when a trend is strong, we get an objective level that we can use as support or resistance. So if you look at this chart here, we're in a strong trend, a strong go trend, and every time that we see the oscillator come back to the 0 line, we can look for support. And if it finds it, we will say that the trend is likely to continue because momentum is resurgent in the direction of the underlying trend. So we want to really pay attention to that 0 line. It allows you to stay with the trend.
So going back to the now, at each one of these pullbacks, nobody knows what's going to happen on the right side of this chart, right? If we only saw up to here, we're pulling back, price is correcting against the trend, and we see our oscillator coming down to the 0 line. So that's our moment of decision, right? We're sticking with that trade so long as our momentum oscillator finds support at 0 and heads back up into that positive direction. And we're going to talk a little bit about the data visualizations on the chart in just a second. But imagine you're a money manager, you want to trade around your positions, right? So you might start a position with a fairly small position size, and then as you see repeated support at the 0 line for the momentum oscillator, you could scale up. They call that pyramiding. You could add to your position size. You could get really outsized positioning and maximize gains to those trends that are working for you in your account. But simultaneously, you have a clear area of risk management, and you have a clear signal when that GoNoGo oscillator breaks below 0. That's the enthusiastic selling that is certainly a threat to any trend. So Alex, let's talk about what this scenario looks like with the GoNoGo icons.
So what we want to do next is draw our eye back to the price chart, right? So we can keep our mind and our attention focused on price. So what we want to do is use data visualization. Oh, I said that a bit too fast. Data visualization to highlight important areas on the chart. The first kind that we're going to talk about are trend continuation icons, and those are the circles. So if a trend is in place and the oscillator finds support at 0, like we just talked about in that previous example, we're able to say that momentum is staying in the direction of the underlying trend. So we're going to put that on the chart in those circles, telling us that we're seeing trend continuation. The second type of icon are counter trend correction icons. And so that's more using the oscillator in a traditional sense of understanding momentum. If our oscillator goes to 5 or above, right, that for us is overbought, and then comes back below that level, we're going to highlight that on a chart with a counter trend correction arrow. When that tells us that price might have been overextended in the short term, and it might come back a little bit. Now, remember, that's not necessarily a trend reversal. They're counter trend corrections. That goes back to your discussion of those seductive relief rallies back in a couple of years ago, right? The trend may not have changed, but we may struggle to go higher in the short term. And then, of course, we then look to the oscillator again to see if it finds support at the 0 line, and then we'll flag the trend continuation icon.
And a quick little note on the placement, right? These icons are showing up as momentum has left the 0 line. That's what identifies to us, articulates that there was support at 0. So we don't immediately buy more as the oscillator reaches the 0 line. We wait for that bounce. Same thing with the counter trend correction arrows. we don't see a level of overbought and immediately think of exhaustion. It's when momentum cools from an overbought or rises from an oversold that we see those counter trend corrections. So quick note to those of you at home, just because something gets overbought doesn't mean it can't stay overbought. And I think Price Headley was mentioning that before. Now, Alex, let's talk about the final piece of the puzzle, volatility squeezes.
Yep. So we know that after periods of reduced volatility can come periods of increased volatility. So don't be afraid of volatility. A lot of people I talk to say, "Oh, it's so crazy right now. There's too much volatility." But if you can find areas of reduced volatility, then you can enjoy the sort of oncoming increased volatility, because it probably will lead to some sort of significant move. So the way we do it, we can read up on Bollinger Band squeezes, Keltner Band squeezes. But the way we do it is we know how important the zero line is. We just talked about that. We know that when in a trend, the zero line should hold as support or resistance. Given that, we look for situations where the oscillator gets stuck at the zero line. That means there's been very little directional pull, very little overbought readings, no oversold readings. All of our inputs are in the neutral territory, and they've remained there for some time. It's like that tug of war between buyers and sellers, and we aren't winning. Nobody's winning. And so while we are seeing that situation, we then have an indicator called the GoNoGo squeeze that creates a grid that climbs for every bar that the oscillator stays at zero. So what we're looking at then is an extended period of reduced volatility. And when that squeeze grid is then broken significantly in one direction, then we can say we've got a break out of a squeeze. And so in this case, it's a continuation. We've been in a go trend, we've moved sideways. You can see how reduced price activity is, how small those bars have become as we consolidate sideways. And then we get the squeeze broken to the upside, which is in the direction of the trend. We get trend continuation, that icon right there. And then we get a nice significant move in that upward direction.
Now, the GoNoGo squeeze can happen at points of trend continuation, the example we're looking at right now, or we can see volatility squeezes build up at points of trend reversal. The most important part of volatility compression is understanding the direction of the break. And oftentimes momentum leads price. And so if we were to break down from here, that's the topping pattern, right? Had this been a no-go trend and we were in no-goes all the way along, building a squeeze, the momentum oscillator would have been in negative, risen to the zero line, and been stuck at zero from below. Then a break above zero would be a trend reversal. So we can use these in two different contexts to our advantage. But now, Alex, we've talked about a lot of concepts in technical analysis. We've talked about volume, volatility. We've talked about trend and momentum. Let's tie this all together here in the last few minutes of today's webinar and just isolate it to those three simple questions. I'm a simple guy. I often can't remember anything after the third bullet point on a list.
Yeah, I stick to three or less. You're better off that way. But in all seriousness, if you can answer these questions, if you can understand what's happening with the trend, what's happening with the oscillator, and if there's anything interesting happening around the zero line, then you can have a complete understanding of the technical analysis of any chart. So let's do one, and then we'll get into some of the really cool features of the implementation with Metastock. But this is that Apple chart, and let's walk through it now using the complete set of tools. Again, nobody can hear anybody, so if you want to just jump in and sort of answer these questions as we go along, we're going to go through it in those three steps. What's the trend for Apple right now? Well, we know we're in a go trend, so there's no confusion. We're in a go trend. The bars are bright blue, so that tells us it's strong. Where's the oscillator? The oscillator is at a value of 2, so we know that there's positive momentum. Now, the third question is there anything interesting happening around the zero line? Well, not currently, but we can say that we recently found support at the zero line, and we know that that's a very, very healthy thing in a trend. So we're in a go trend, the bars are bright blue, oscillators in positive territory, we recently found support at the zero line. That's your technical analysis on Apple. How about volume? Volume is not particularly heavy right now. You can see that there is no blue on the ribbon there. So there's your technical analysis on Apple. And if we move...
Well, and just before we move on from there, we have the counter trend correction icon appearing above price. And so if you haven't owned Apple in November and December, and this is not a securities recommendation. For illustrative purposes, if we're looking at this chart, do you buy in to a go trend at a point where it's just reached an overbought level in momentum? Well, the counter trend correction arrow tells us the price may struggle to move higher in the short term, and that if we came down to test the zero line, there's an optimal point for trend re-entry or entry point into that trend. So I think I hear a lot of traders who, somewhere after this second week of rally, they think, missed the move, it's already over, right? Well, consider that, first 2 weeks of a trend back here, there was still plenty to participate in. So a logical entry point might be looking for the retest. And again, that's going to be, to your own risk tolerance, to your objectives, your time frame, and your trading style. So Alex, moving back to the presentation, let's talk about the implementation in Metastock.
Yeah, so Metastock has a couple of great tools that we can use to just help make everything easier. One is the expert commentary. I love this, and it's really like having you there with me or me there with you, and we can discuss these charts and say, what is it saying at the moment? And what we do is with the expert commentary is just give an interpretation from a GoNoGo perspective. So those 3 questions that we were just talking about, that's all going to be right there at the top. You hover over any bar, you open up the commentary, and you'll get us walking through those things. What's the trend? Where's the oscillator? Are there any icons on the current bar? And what's happening with the squeeze? And then underneath, we explain the concepts and the tools and all the rest of it. But it's just like having that quick understanding from what the GoNoGo charts are trying to tell us. And then the next thing, of course, is the explorations. I know Jeff loves screening. He talks about it a lot. And so do we. I mean, it just is the biggest time saver. So we can go through on Metastock and we can just say, find me all the securities that are showing a new go bar today, right? Or show me securities that are in a squeeze. They're in a max GoNoGo squeeze. Show me any securities that have an icon on the current bar. So when you do this, you can really, really whittle down your time and get it to where you need to go very, very quickly. So those are a couple of fantastic features of the implementation with Metastock.
Now, I know we have a few other examples in here, but we have also run out of time. Jeff, if you'd like us to keep going for a couple of minutes, we can. Otherwise, happy to turn it over to you to talk a little bit about how folks can take advantage.
We did start you a little bit late, so if you can wrap up within a couple of minutes, that's great.
Perfect. We'll just go through 2 more examples. Remember those 3 questions. Where is the trend? Where is the oscillator? Is there anything important happening at the zero line? MTZ, Mastic Incorporated, coming out of a very long drawdown and re-entering a go trend. So as we saw, momentum leads price. We saw the negativity, the selling enthusiasm, repeatedly retesting the zero line, being rejected below, trend continuation icons. And here we come up, we build the squeeze. As I was saying, it can also be at points of trend reversal. Now we break to the upside. That positive momentum precedes the color change in our trend model. Now we're in a go trend. We've got strong blue bars. The oscillator is at 4, and we are now on light volume. So that's MTZ for you. Alex, why don't you talk to us about IESC? Yeah,
and these are coming out of some relative strength that we're seeing in industrials and the heavy construction index. So when you tie it all together, and now you're looking for opportunities in places that make sense. Here's another one. What I like about this is that it's very, very easy to see the break of prior high resistance, right? So if we're keeping this price panel large, look at how we screen through that resistance. So this came across my desk a couple of days ago. We've got strong blue bars. We've recently found support close to the zero line on the oscillator. Volume is heavy. We're seeing market participation. We're seeing enthusiasm. But I love to see this from the 20th. When we entered that go trend, volume picked up right away. That's that confirmation that we're talking about. And of course, we broke above the zero line several bars ahead of that, as you said, momentum being a leading indicator. But now we are at new highs. We closed at the top of the bar yesterday, so that's a great sign. And we're in a go trend with momentum on our side for IESC.
Absolutely. Last one here. CHGG is the ticker symbol. Shout it out at home. We're in a strong go trend. We've got an oscillator at 3, positive territory. We had broken to positive territory on the momentum oscillator. Trend changed to go colors, first weak form, now strong. We came back to test the zero line, and we had that tug of war that Alex was talking about. The no clear momentum direction, buyers and sellers really in a tug of war as the price range began to narrow. We broke back positive. See that trend continuation icon, and we're back off in strong go trend colors.
And one of the things that's fantastic about this chart was number one, it shows what you were talking about a couple of slides ago, where maybe you missed that initial pop of that when it went to that go trend and it did all of that work in one bar. Well, this is almost a way of automating that buy the dip kind of idea, right? You're looking at a bull flag, you're looking at a triangle. You can put a couple of lines on this, and you can certainly see some sort of pattern. And as you're watching that pattern develop, you look to the oscillator to see it ride the zero line, and you think, do I get in? Should I have I missed it? You know, what situation am I looking at here? And then as soon as we break that squeeze, we know, okay, momentum is resurging in the direction of this move. So this is a relatively low risk opportunity, sort of buying that first dip after a new trend has been identified.
Absolutely. Very well said. Alex, it's so great to talk markets with you. Jeff, Kelly, Metastock team, thank you so much for having us back on today's summit. And for all of you in the audience, congratulations on taking an investment of an hour to think about your trading discipline and your process. If our tools can be of help to you, by all means, we're hoping that you'll reach out to us, info@GoNoGoCharts.com. But the Metastock implementation is just incredible. So make sure to take advantage of that. And Jeff, thank you. We'll be seeing you in the new year.
All right. One quick question, if you don't mind, Tyler.
Yeah, please.
B has asked a couple times. He wants to know if he can use this with intraday charts.
100%. When we were talking about the multiple time frames of technical analysis a little earlier on in the session, we talked about how the tool, and really any technical analysis tool, work the exact same way on any periodicity. So the trend model that we're using on a weekly or monthly candle is the exact same trend model we're using on an hourly or 1 minute or 5 minute candle. So you can use these on any time frame that you're trading. In fact, we do have a lot of clients who are trading extremely short term. They might just be scalping, but understanding trend is a core concept no matter what your trading objective is. If you're a position trader or a swing trader, or you're a long-term investment manager just thinking about asset allocation, these tools have something for just about everybody.
Petrus says, thank you guys. That was valuable. So thank you, Petrus. Glad you enjoyed it. All right, very cool. Thanks, guys. I appreciate it.
Thank you, Jeff. We'll talk to you soon.
Have a good holiday. We'll talk soon.
You as well. Bye-bye.
All right, cool.